Hello and welcome to the very first edition of Talking Property Tax with Julia Hartman. Now, I'm Ben Kingsley. I'm the founder and managing director of Empower Wealth. And as valued customers, I'm delighted to be able to share with you these important tax insights from one of Australia's most respected residential property tax advisors in the country. Now, Julia Hartman is our Chief Technical Tax Advisor for the Empower Wealth business, as we are associated with the Band Tax Group of accountants across Australia. Now, Julia leads that business, and she is an absolute expert when it comes to residential property tax. In fact, what Julia doesn't know about tax really isn't worth knowing. Now, I also love the idea that we get to sharpen iron with each other and being able to run that group of accountants and getting the best insights and taking a deeper dive into the tax issues that matter for our clients. So I'm really pleased that we're introducing this new educational tax series that will be rolling out over the months and years to come that will help you get more educated when it comes to guiding you through the tax maze. And I've got to admit, it is absolutely a tax maze. And so you need to make sure before you take any action that you always get some tax advice prior to that. So hang around, because we're going to be talking about these golden 5 principles we need to understand. We're going to cover off on negative gearing. We're going to cover off on tax planning of turning your principal place of residence into an investment property. We're going to revisit the 6-year rule, important elements associated with that. We're going to look at potentially the risks and rewards of turning your principal place of residence or a holiday home into an income producing property and the consequences associated with that. And finally, we're going to finish off with something that's absolutely worth hanging around for, and that is the big tax changes that are coming in 2024 and what that means in terms of how you might structure up your situation. So without further ado, all I need to do now is welcome Julia. Thanks for joining us.
Thank you for having me, Ben.
Now, Julia, I wanted to talk about one of the observations. You know, we were chatting, and as we always do each week, and we were talking about the challenges you have as a tax advisor, as an accountant for clients, because a lot of the time people come to you once a year and tell you, I've done this, and you go, oh, have you? Like, that's crazy. Or you can't really say crazy to them out loud, but you're basically trying to sort of highlight the fact that there's real challenges around people taking action and then coming to tell the tax accountant what they've done.
It's too late once they've signed the contract. I can't believe they'll spend $500 on a pest in building inspection and not a couple of $100 on coming and discussing it with their accountant, and they're spending $500,000.
So that's what we're focusing in on here with these top 5 items that we want to talk about. We want to basically highlight to the fact that your accountant needs to be a proactive member of your advisory team. They need to understand what you're thinking so they can get in front and tell you and advise you around those tax consequences, because often, as we've said, they come in after the fact, and that is too late. The other thing that we also wanted to focus in on here in terms of this session was to talk about how sometimes some accountants can get too fixated on reducing tax and just having the blinkers on, just looking at the tax story, when we know that there's basically a bigger story at play here, and that is around the ultimate return on investment. So we know that there's some accountants who talk to their clients about, you're paying too much tax, so why not invest in residential property? And then people go, okay, I've been told by my tax accountants to go and invest in residential property. So they go and do a search and they come across off the plan or house and land packages or spruikers who are basically telling them that you can hold this property for $28 a week and it doesn't cost you much to basically maintain that. So we've got challenges around off the plan, we've got challenges around house and land package, and the final one is around negative gearing, because they're telling their customer to actually reduce their tax, and negative gearing is a way to do that. So this is where I want to bring in your expertise, Julia. We're talking about what is negative gearing. Can we explain that in really simple terms, and then we can talk more about the consequences of that?
Okay, Ben. Well, here's something I prepared earlier. So, Ben, here we have a classic investment property situation where the rent's 20,000 and the interest might be 15,000, the rates and insurance 4,000, property agent 2,000, and depreciation 3,000. Remember that depreciation. So that means that for tax purposes, there's a $4,000 loss because all those expenses exceed the rent. Now, if the person's in the 32 cents in the dollar tax bracket, then that will get them a $1,280 refund. So that's negative gearing. You've made a loss in your tax return. It gives you a tax refund. But if you go to the other side and look at the cash flow entries, which is the rent coming in, the interest going out, the rates and insurance going out, and the property agent going out, then add the tax refund to it. Because you don't have that 3,000 in depreciation coming out of your pocket, then you've got a $280 positive cash flow coming from that property. $1,028 from the tax office, which offset your $1,000 cash flow loss and gave you $280 in your hand.
So that explains the concept of negative gearing. So the property or the costs exceed the income that we're receiving. But if there is some depreciation on the property, that can also potentially turn that property into a negatively geared but positive cash flow type property. So there's some things that just need to land here. And I think what's important to understand in this particular story is this idea of, okay, so what types of properties should I be buying? Because at the end of the day, I want to get an overall return on investment. I shouldn't be doing it for tax purposes, should I, Julia?
No, it's about what the eventual return on the investment. Yeah, but you've also got to work out whether you can afford to hold the property, and sometimes that tax refund will make the difference, and that's part of the compromise. You need to profile what is important to you, and that's one of the reasons you need to talk to your accountant.
So when people come to me, Julia, and they say, hey, I've got this shiny new off the plan property, or I've potentially got this house and land property, what are some of the things that you are looking at? Because obviously with those newer items, there's huge depreciation schedules attached to those. But what is the ultimate thing that people should be looking for when it comes to the capital appreciation? Because that's the trade-off, isn't it? If you're going to run a property that is negatively geared, you want to get that capital return, because if you don't, it's not really a good idea at all.
No, well, it's a trade-off. It's horses for courses, maybe. It's a lot of things that are particular to their circumstances. But you're absolutely right, Ben. The shortage of supply is where you get the capital growth, and that's generally close to amenities, which means an older house, and an older house doesn't give you the depreciation. If it hasn't been built or substantially renovated after the 16th of September 1997, then you're not going to get any depreciation for it, and none of those lovely refunds that don't come out of your pocket. And
at the end of the day, the depreciation does get added back to the cost base, which we'll cover off in a later session in today's sort of education. But it sort of highlights to me some key takeaways here is that negative gearing should not be the primary reason why you embark on property investing, right? You should always think about that overall return on investment and having a long-term play. Do you encourage people to look at property from a speculative or a quick turnover point of view, Julia?
Oh no, the transaction costs are far too high to be able to do that with property. But I tell you, there's another advantage in property that I like my clients to get into, because they fritter away their money if they're not in debt. If they're in debt, as Noel Whittaker says, they'll always pay their debts first and then waste the rest. So
that's right. So having that fixed obligation in terms of doing that, and obviously that property is growing in value whilst you sleep. So the final sort of message I've got here from my point of view is different properties and different gearing levels serve up different results. So we've learned through Julia that obviously there are simple calculations made in terms of whether it's going to be positive, neutral, or negatively geared. We know that certain types of properties, i.e. you heard the gold from Julia a moment ago, older properties where there's full amenity and there's a shortage of supply, that's where the land value is at its premium, and that's ultimately where you get the long-term capital growth. So if you're in a fortunate position where you have substantial income and you can carry those losses, then you may be looking for some of those locations that are highly prized in those inner city areas and the middle ring suburbs of a big city. But if you're conscious of affordability or your money doesn't stretch that far, you are going to then start to look at property through a different lens, which is around the lens of how much do I need to fork out to maintain and hold on to that property. So you may pivot in terms of looking for a higher yielding property, which means that you might come across neutrally geared properties or slightly positively geared properties, which will build over time. And it's probably my final question for you around what you've seen over your journey, Julia, in the sense that you see people who may have had negatively geared properties. What happens to those properties over the medium to long term?
Oh, they become positively geared, don't they, as rents go up, especially if values go up. But that's another thing about inner city older properties. You probably don't get as good a rent return for the price you pay either. So you're focusing on capital growth. And if you're my age, you might not be interested in that. You might be too old to see the capital growth ever happen.
So that's where, again, it's horses for courses. So a good takeaway there, we shouldn't be investing in negatively geared properties for just the sake of reducing our tax. We ultimately need to get the blend right based on our household cash position. And that's why you need to sit down with your accountant or your property investment advisor to do the numbers around what might be affordable as part of that story. So thank you, Julia, for point number one. Let's look at the second point here. And this is around turning your existing principal place of residence into an investment property. So I want to do some scene setting here, right? Because there's a really important explanation we need to make. And this is a concept called the cost base of a property. So every property and every scenario can potentially adjust that cost base. So can you, for the benefit of the audience, tell us a little bit about how you calculate a cost base?
Okay, well, your cost base is what you're going to deduct from the selling price to work out how much capital gains tax you paid. So it's very significant and involves a lot of record keeping. So most cases you'll start with the price you originally paid for the property. But if it was your main residence at the start and you've later rented it out, there's a good chance that is reset to the market value at the time you did that. So just that aside, we're starting with the first element of the cost base, which is either market value or the price you paid. Then you add to that cost base everything that you haven't otherwise claimed a tax deduction for. So if you're living there and unable to claim the interest and rates, you can increase the cost base by that. Even cleaning materials, of course, any improvements increase the cost base. And as you mentioned earlier, Ben, any depreciation you could have claimed decreases the cost base. But remembering you get the 50% discount on a capital gain, so it only decreases the cost base by half of what you've claimed. And the grand plan is to sell when you've retired anyway.
So these cost bases, we're talking about also the big ones are stamp duty as well, in terms of because you can't claim that or write that off over the immediate term. The other one that you can't claim as a cost base is lender's mortgage insurance. You can write that off over 5 years. So this cost base is really important when we come back to the original question posed. So we're talking about a household that has probably outgrown their property. And so they might be upgrading or potentially even downsizing. But rather than sell that property, they're in a position to potentially turn that property into a passive investment vehicle. So what are some of the other important things that we need to consider when we are turning our existing property into an investment property going forward?
Assuming that they're buying another property to live in during this time, we can address the alternative later, then because it's been their home all that time, you get the reset to market value. Now, all your rates and interest and all that's deductible against the rent income. But the problem is interest is only deductible if the money borrowed was used to buy an income producing asset. So you've got to look at the loan that you originally took out for the property, and that can be refinanced, that's fine. But looking at this loan, you've got to say, well, have I withdrawn money because I used a redraw facility because I've been ahead? have I even been putting my wages in there and drawing it out? If you've been doing that, you've probably got no interest deductibility. Ideally, an offset account, which I think you probably describe that better than I do, Ben, is a way of making sure that you don't mess with the deductibility of the loan. So when you go and buy another property, you can take your money out of the offset account and use that as a deposit for your new home. Whereas if you redraw it out of the loan, then that's drawing for private purposes. It's a new loan. You can never get back anything you've paid off the loan for the house that now becomes income producing.
You can never get back any of the loan that you've paid down. That's gold. That is the big mistake that I often see people make. And it shows that lack of planning again, because what we are talking about here is if you keep an offset account, you are keeping the separation of the deductibility from the actual loan account. So often we hear people sort of saying, oh, I'm just going to take the money out of redraw and then I'm going to basically use that. So the loan balance goes up higher. And so surely I can claim that because that loan is still against the existing property that I'm turning into an investment property. And the answer to that, as Julia has just highlighted to you, is a definite no. You can't do that. Now, we always talk about deductible and non-deductible debt. Julia, do you want to explain that to the audience around the importance of having your non-deductible debt high and your non-deductible debt low and your deductible debt higher?
Right. Well, to pay $1 in interest on non-deductible debt, you have to earn $1.50, pay 50 cents in tax, and then pay the other $1. Whereas because deductible debt is deductible, you might earn the whole $1, but you don't get taxed on it because you've got the interest expense to offset against it. So you've got to earn a half again to pay interest. Very important. And many people that have done what we've described, moved out of their home, they can't afford it. They've borrowed 100% for their new home and it's just too hard.
And so the idea here in terms of forward planning can be a game changer for people. We often see people taking the easy road in selling their existing property to buy their new family home, whereas in reality, having two of those assets accumulating in value over the next 10 or 20 years, because they often look back and say 5 years later or 10 years later when that property's gone up in significant value and they go, oh, we shouldn't have sold that property. It would have been better to keep that. Yes, it would have. And this is why that preparation and that planning in terms of separating that money out into the offset causes a real uplift in people's wealth creation potential. And so again, it comes back to getting that cash flow analysis done to make sure that they can hold that property. And even if that property is positively geared, we still, oh, look, I would have paid tax on it. Yes, you would have. But you've got an asset that's growing in significant value. So why wouldn't you have kept it? Because ultimately that positively geared property could potentially help you buy another property, which can help you service that debt and pay that off. Because ultimately the long-term game here is to live off the passive rental income that you're going to generate from having 1, 2, or 3 properties, right, Julia?
Yes, but some people just can't afford because if they're going up to their $1 million property, they interest on $1 million debt's just not on.
Well, that's where changing that money or bringing that big offset balance across and reducing that. So that's ultimately what we've got to do here. This is why getting that tax advice and that cash flow analysis work done is really powerful. Now, Julie, there was one thing you mentioned in there before about setting the value of the cost base. Can you explain to me, if I go and buy a property in an area that does experience a downturn in terms of its value, how can that be a concern or a trap for me?
Yeah, major problem. The classic thing is people leave a mining town to go somewhere else to find work and they decide that they'll rent their property out because they'll come back one day when things turn around. And they've reset the cost base to this low market value. And we've had it happen in Mackay where people paid $500,000 for their house, downturn, market value is $250,000. They go off to WA to get some work and they rented it out. So at the point they first used it to produce income, its market value was reset. they might still owe 400,000. Finally sell it for 400,000, and the tax office comes along and says that's a $150,000 capital gain there. Thank you very much. It's more to it than that, but that's basically the concept.
So I mean, that is obviously life-shattering if that experience was to happen to people. So that is a bit of gold. That's the technical element that, again, why for case by case, you need to be speaking to your accountant to get an understanding of how that would play itself out. There is some obviously finer details, which we don't have time for here today in this session, but it just highlights that there are risks on the downside when it comes to how you reset that cost base. And so we wanted to make sure that that was a key takeaway of our session today as well. So wrapping that up, failing to plan is also the challenge around the pitfalls, renting the property out if it's experienced a severe downturn in terms of valuation, you've got to be mindful of, and making sure, and I cannot stress this enough, that you keep money separated in terms of deductible and non-deductible, and keeping that in an offset account as opposed to redraw, because the redraw, you will lose that deductibility even if you redraw those funds out and top that loan back up. So that's why using an offset account is a very powerful method. Okay, point number 3 in our top 5 list is the 6-year rule. So firstly, what is the 6-year rule, Julia, and how does it work?
Providing you first lived in the property before you rent it out, you can continue to cover it with your main residence exemption for up to 6 years after you move out while it's rented. If you're not renting it out, if you just leave the kids there, then you get an indefinite period of time. It doesn't necessarily have to be 6 years. Now, of course, you can't cover another property during that time with your main residence exemption. So if you've gone and moved and bought somewhere else, you might want to claim that as your main residence instead. The good thing is that you don't have to decide until you sell one of those properties. You can keep your options open on both, but you need to keep records on both. Record keeping is the biggest tax lurk there is. Good record keeping.
So let me get this right. So what we're basically talking about is I can have and own a property. My work might take me somewhere else. I can then rent that property out and I can use my exemption, my principal place of residence exemption, for up to 6 years. So any capital gain that may be experienced in that property, I still get to keep. So in other words, because it is my principal place of residence, if I sell it after, say, 5 years and 5 months, any of that capital gain I get to keep?
That's right, no capital gains tax.
Now, what happens if I then move back? So my work brings me back to the location where my property is. Can I go back into my property? And then if, again, another contract comes up or another opportunity to move takes place, can I keep resetting that 6-year rule?
Oh, yes. 2 terms of parliament. That's the plan.
So tell me how that works. I basically come back in. Is there a period of time that I need to be back in the property for?
Well, you know, it needs to be fair dinkum that you come back and live there. So you can't say, well, I've got 4 weeks annual leave, I'll go back and reset it because you're on holidays, you're not living there. You've got to be able to work from there, send the kids to school from there, change your address on everything. So, yeah.
So, I mean, this is obviously a great opportunity again where you can hedge your bets. Now, you also talked about, because I want to dive deeper into the other element there. So if I've got a couple of properties and I'm moving between those 2 properties, are you also telling me that I don't need to declare to the tax office which is my principal place of residence until such time as I sell the property?
Yeah, you don't have to tell them which one you're choosing to cover with your main residence exemption. It's very important if you're trying to keep a toe in each property that you do actually change your address to the one you're moving to so that you can say, look, I really did live there too. And then, you know, you've got them both covered. But yeah, like it should be on your tax return, your driver's license, the electoral roll, and then your options are open to yourself.
And so the benefit of that are that based on the analysis that I can do, if I do choose to sell one property, I can then work out what my best and fairest tax position is in terms of what I need to pay under the rules.
And we all know what the fairest tax position is, don't we, Ben?
Which is the lowest tax position, of course. So there's some takeaways there in terms of. So I want to talk about some important messages there. There's one other thing. We haven't talked about people who have moved offshore. We're only talked about people who have moved interstate. And there really is some changes that have occurred in the tax legislation around people moving offshore. Now, we don't have enough time to go into that deep dive. We'll do another session on this at another time, Julia, but can you just give us a flavour of what that means for those people who might be expatriates who have kept their home and have moved offshore?
They're fine with the 6-year rule, but if they don't come back at the end of the 6 years, they're in strife. If they try and sell within that 6 years, they are in strife. They could lose their main residence exemption dating all the way back to when they originally purchased the property. They don't get any reset to market value. They're in all sorts of strife. So it's a dilemma. You either sell before you go overseas or risk that you're going to be forced to sell while you're overseas and lose all your main residence exemption. There's a bit more, as you say, to it, but another reason you need to talk to your accountant before you do it.
Couldn't have said it better myself, Julia. Couldn't have said it better myself. Now, moving on to point number 4. This one's a fun one, but it's going to basically play out given the post-COVID world in which we're living in. So we have seen a lift of people buying second and third properties, whether they're intending to live there because of COVID or outrun any lockdowns, or that the whole change in the work-life balance that we're getting in terms of being able to work from home versus work in a city location. So we're going to see a lot of people with multiple properties, whether they be principal places of residence or whether they also potentially be holiday homes. So what I want to talk about here is, what are the implications that if I do decide to rent out my property? So let's say I live in a suburban area, in a typical suburb, and then I've bought my regional property or my beach property, and I can now go and work down there on a more regular basis. And I'm thinking, I actually want to just pick up a little bit of spare cash on the side, nice little side hustle. What is my issues around doing such a thing?
Oh, as in Airbnb it or something like that?
Yes, like Airbnb,
Right.
renting it out for a short period of time.
Right. Well, if you left your main residence back in Melbourne, let's just pretend you've run away from Melbourne here, Ben, and
Sure.
don't want to go back, and you've bought this place in WA and you're sitting there enjoying it.
Thought,
and then
yes.
and then the kids say, no, we want to go back to school. So
Yes.
I don't know, but example. So if you're away and you were renting out your home over in Melbourne, then you'd be fine. You get what we talked about, the 6-year rule, would have reset your market value, but that's cool. So then you bought this place over in WA and then the kids want to go back. So you then, remember we had a choice as to which one you cover with your main residence exemption. We don't need to worry about that, but you might sell that WA one long before you sell Melbourne. So you might decide you want to cover it with your main residence exemption. That's going to reset when you first rent it out. Now, if you don't want that to reset because you've just incurred the purchase price, all this stamp duty, your reset to market value is probably just going to bring you back to the purchase price. You've only just bought it. So if you don't want to incur that, you want to avoid this reset. So then you might say, no, I've left my main residence exemption in Melbourne. I'm going to expose the one in WA so that the reset can't be triggered. That's one of the tricks to get around it, because the reset is compulsory if you qualify. So then you then go back to Melbourne and you might Airbnb the place. So you're fine there. But if you do decide to cover it with your come back. The point is that you can only cover a place with your main residence exemption, the 6-year rule, if you are absent from it. You're required to be absent. So if you're over in WA with your beach house and you decide to take in foreign students while they're quarantining or whatever, and they live there with you, well, then you're not absent from it, so you don't get to use the 6-year rule. So now half of the place might be covered by your main residence exemption and half exposed to capital gains tax. Same likelihood if you're trying to cover Melbourne still with your main residence
Yes.
exemption and you just go and live with your in-laws in WA, then you mightn't have changed your address to WA. You might still be considered to be living. Your personal effects might be locked up in the garage. Then you are not absent from that either. Even though you're in the lockdown over in WA, you're not absent from that house. It's still your home. So you don't get to use the absent rule, even though you've rented it out and the whole place is empty. You know, you're not there at all, and they get the whole use of the whole place. It still gets caught not getting the absent rule.
So you really do need, you need to pack up your house. You need to move out there. You can't just let it out like an Airbnb or a short-term stay, thinking that you're going to get a nice little side hustle of income on the side. The risk you pose here is you are breaking the principal place of resident exemption, which means that, as Julia just said, all of a sudden the 100% of any future capital gain is now at risk. And there's also a huge amount of record keeping that would then take place, isn't there, Julia, for the future time that you're owning that property?
Yeah, I think I get now where you were going to on this. So if we say you've done that, you've kept your personal effects there because you weren't going to WA for long, you haven't changed your address on your license or anything like that, then you've rented it out. So you've reset the cost base to market value. You're not absent. It's used to produce income, but you're not absent. So you don't get to have your main residence exemption over it. So any capital gain going forward from that reset is going to get taxed pro rata. You might come back and you might live there for 5 years and you only rented it out for a year. But still, you've got to keep all your records, and 1/6 of the capital gain is going to be taxable. And that might be more than the rent you got in the year when you think about capital growth at the moment.
Well, I think it's about priorities, right? It's about sort of saying, yes, is the takeaway for me is that little bit of cash worth it? If you're short staying, let's say you're 2 months away or a month away, and you're thinking, I want to do a quick bit of cash here, you are constantly at risk of, one, resetting the cost base, and two, then effectively from that point forward, you're going to have to split your capital gain provision and pay tax on some of that when you would never have had to do that for your principal place of residence. Now, it gets a little bit more interesting with holiday homes because you can only have one principal place of residence, but it's also about how you manage that blend of income producing versus using it for your own purpose. And, there's also a lot of other issues around how you document claiming that you are trying to let that property out. If you just say, oh, that holiday home is just is available for rent, and I've got a little sign out the front, is that enough, Julia, for people to satisfy the ATO?
It worked in one case that the ATO took on, but generally they're out hunting for people that have holiday homes that they want to claim the expenses as a tax deduction, but really don't want strangers in their holiday home. They're hunting for that. We had a really nasty audit down in Melbourne once where they criticised that it wasn't really a commercial rental. They really didn't want people there because their advert on Airbnb wasn't upbeat enough. It wasn't gleaming enough. They didn't have a coffee machine there and they didn't have free internet. Everyone's got to have that. Otherwise, you just don't want to rent it. And what I found most unnerving is they tried to argue that because they didn't advertise on Stays and all the other ones, they only advertised on Airbnb, then they weren't really trying to let it. And that is unnerving because Airbnb is the only one that really vets the guests before they come. So you don't really want to go with the other ones.
There's some lessons here for anyone who's thinking about having a blended second property where you're looking to holiday let or doing what you're doing. Record keeping is going to be key. You know that the ATO is going to scrutinise that potentially as well. So again, make sure you talk to your accountant, because also depending on, you won't have your principal place of resident exemption. So your capital gain in the event that you do sell it is going to have a 50% sort of exemption, but that's it. Depending on which entity you buy it in. I don't want to go down that story, but let's assume that you bought it in your personal name. That's also critical as well. So my takeaways from this are simple. For that little bit of extra cash for the principal place of residence home, I'm not sure that that's worth it. If you are permanently leaving that property and you're moving all of your goods out of that property, 6-year rule kicks in. I can understand how that program works. In terms of holiday letting and holiday rentals, we know the risks, the rewards of doing such a thing as well. So I always encourage people that you want to be really clear about the purpose of that asset. And if you want to get some side income on your holiday homes, speak to your accountant. Make sure you understand what the requirements are, because that will get you into the right understanding where you can be informed. Now, I promised, Julia, we're going to move on to our final one now. I promised to finish off with this educational session with some serious food for thought about future tax planning when it comes to 2024. We've got some interesting news coming through in terms of our personal tax rates. But as a scene setter, what I wanted to talk about first is we hear stories of people who are buying property with different types of percentage of ownerships. Can you share with us some of the knowledge around why people had different ownership shares and what the consequences of that shared ownership was, or those different splits in terms of their tax position?
Well, regardless of the percentage, the first reason you want two people on that title is so that the other person can't sell it out from under you if it's common asset anyway. You've also got the issue of the bank's loan and the tax office trying to argue that, well, why two people on the loan and only one person on the title? So they don't get away with it necessarily. They try and argue that only 50% of the interest is tax deductible. So I really like the concept of having more than one person on the title. So now we're looking at 99-1, 50-50, anything else is somewhere in between.
Yep.
Yeah, but they're the two purposes. So generally we used to say, 99-1, so that if it's really negative geared and going to be negatively geared for a long time, the person that that's in the highest tax bracket gets the benefit of it. You might look at time to retirement when it's going to be sold. Again, this is why you see your accountant before you sign the contract, so you can work out this is the strategy, this is how we expect it to go. It never goes exactly as planned, but you've got to have a plan at least.
Yep.
So we'd go 99-1 on that. Now, but the downside is, of course, when you sell it, then 99% of the capital gain goes to that person. And even if the tax brackets change, because one continues to work or whatever, you've still got this issue that it's all going to be in one person. And we're talking, you hold it long enough to make several $100,000 in capital gain. So we're talking big things that are all going to happen in the 1 year. So if you can split that between two people, especially when they retire, that's going to be quite a tax saving. So that is the benefit of 50-50. Now, the big thing that's happening on the 1st of July 2024 is the tax rate for anyone that earns between $45,000 and $200,000 is going to be 30% plus probably 2% Medicare, depending on what they tend to tack on things to that. But so let's assume 32%. So even if you've got the low income spouse only earning $50,000 a year and the property is $10,000 negative geared, well, that brings them down to 45. So they're going to get 32% of $5,000 back in their refund, and the high income earner might be only on $180,000 a year, brings them down to $175,000. They're still going to get 32 cents of $5,000. So exactly the same dollar refund, no matter which name it's in. As long as you're in the same tax bracket, your income doesn't have to be the same. So it's starting to look better for 50-50 for a lot of people. And of course, that is a good outcome when it comes to capital gain. Because also when you're looking at capital gain, you might be wanting to put money into super to minimise that gain. Of course, you get an individual cap of $27,500. So that gives you twice the amount you can put to super too.
Oh, I think there's some gold, and I wanted to finish off with that. That's exactly right. My takeaway from that is, yes, I do believe that we're going to see more and more of those 50-50 splits as being more common. I think that, subject to the government working out how they're going to pay for all the debt that they've got, we might have some special levies or what have you, but I just love this idea that Australians will be paying less tax at the personal tax level, which then allows them to obviously get on and build out a wealthier tomorrow for themselves and their family and be less of a burden on the government in retirement. So that's probably how I'll close out that final point. So I just wanted to say, I'm hoping everyone's thinking what I'm thinking, and that is that you've spent this time with us in this session, the ways that I got. So thank you, Julia, for those incredible takeaways. There's no doubt that the information that you're sharing is of high value to us in your technical skill. There is one other point that I wanted to raise as a closeout, as a reminder. We're recording this in early to mid-October of 2021. What's the significance of the 31st of October for some people who may not be working with a tax accountant, Julia?
Yeah, well, everyone that hasn't got a tax agent has to have their tax return in by the 31st of October, whereas so they can keep us working all year, we get an extension to lodge up until mid-May, sometimes the beginning of June. So the idea is if you're not lodged your tax return by the 31st of October, you need to contact a tax agent to get on their lodgement program, which will take you out to that longer period of time.
So effectively you can extend, if you've got a tax liability and you can keep that money in your offset account and you don't have to pay it until the following year, as opposed to lodging and potentially paying that money earlier, means your money's working a little bit harder for you. Is that fair to say, Julia?
Well, interest rates are so low. I'd like to think about the stress levels of the poor account when everyone comes in on the 31st of May. Give us a break.
But you get the point, and that is about making sure you're working with your accountant to get the maximum dollar value in terms of how you look after your money. But I like that as a final point. Now, I just wanted to say that that's the wrap for our very first Talking Property Tax with Julia Hartman. She's obviously a thought leader in this space, and her technical knowledge in the property space is second to none. So we wanted to thank you, Julia, for this time. I look forward to doing more of these. We are going to pick some topics where we're going to take a deeper dive into those topics, and that will allow us to educate our community of Empower Wealth clients and also potentially the broader community as well. So thank you very, very much for your time. And before I go, I just want to also remind people that if you are dealing with a tax accountant, make sure that you talk to a tax accountant who thinks a bigger picture, who is helping you with your estate planning, who's helping with you your future wealth building plan. So they understand your grander mission, your grander goals and desires, because when you find that great accountant who is not just thinking about simple tax return in and out the door, they're actually trying to add value as part of your overall wealth creation journey, guess what? You've got the right accountant when you find that type of accountant, and they should be your accountant for life. That's really important. From our point of view, that's the way we're training up our senior accountants and our people coming through our business. We want those accountants to take a bigger interest, not just have the blinkers on, just looking at the standard tax return, other ways in which they can help guide the client. And we've learned from this session today that there is a lot of minutia in terms of decisions that you make about your property today or your future plans tomorrow. So that's why it's absolutely critical to get that tax advice up front, so you're not coming into your accountant and they're saying, oh no, that's just changed your cost base. Oh no, that's just made your situation far more difficult. Now you're going to have to do paper trails and paper reporting for the next 10 or 20 years, whatever that looks like, for very, very marginal gain. So it's really important to do that. So if you're interested in talking to one of Empower Wealth's senior accountants who specialize in property investment tax, please make sure you check out our website at empowerwealth.com.au/tax, and you can book your free consultation. That's right, free initial consultation, no obligation, to learn more about our services. And hopefully we can get you on the right path to better tax, but more importantly, a greater return on your investments so you can enjoy wealthier tomorrows. Thanks very much for tuning in to our very first session, and we look forward to catching up with you real soon. And remember, knowledge is empowering, but only if you act on it.